Imagine that Richard Wyckoff, the master speculator and a titan of Wall Street's golden age, were alive today. Imagine that we could present him with a simple but profound challenge. Here is $100,000 of starting capital. How would you, based upon your timeless and hard-won principles, construct a portfolio from scratch in the complex and volatile markets of the 21st century? What would be your plan of action from the very first dollar to the final profitable campaign? This is not an academic exercise. It is a practical blueprint, a hypothetical reconstruction of a master's thought process. This study will lay out that plan. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. The first and most critical step in this hypothetical campaign would not involve looking at a single stock chart. It would be a fundamental internal process of defining the correct professional attitude toward the capital itself. This is step number 1. The capital must be treated as professional working capital, not as a speculative windfall. Richard Wyckoff would not view $100,000 as a get-rich-quick stake to be gambled on a single hot tip or a volatile, unproven stock. He would view it with the serious and dispassionate eye of a businessman. This capital is not a lottery ticket. It is the raw material, the inventory, and the lifeblood of his new professional enterprise. Its preservation, therefore, is his first and most sacred duty. This mindset immediately gives rise to the foundational principles of risk management. The amateur trader, upon receiving a sum of capital, immediately begins to fantasize about the profits he can make. The professional, by contrast, immediately begins to calculate the risks he must control. Wyckoff would have established as an inviolable law of operation a strict rule for limiting risk on any single speculative idea. Based on his writings and the conservative, business-like approach he championed, this would almost certainly be a 1 to 2% rule. This means that on any single trading campaign, the maximum acceptable loss would be limited to 1 to 2% of the total portfolio value. For a $100,000 portfolio, this translates to a maximum risk of $1,000 to $2,000 per trade. This is not a vague guideline, it is a mathematical and psychological necessity. It is the great wall of defense that protects the operator's business from the devastating impact of the inevitable losing trades. By predefining and strictly limiting his risk on every single operation, Wyckoff would ensure that no single error in judgment could ever be allowed to inflict a catastrophic blow to his working capital. This rule guarantees survival. And survival is the non-negotiable prerequisite for ultimate success. This professional risk-first attitude is the fundamental starting point from which all subsequent decisions would flow. With the foundational mindset of capital preservation firmly established, we proceed to the second step in Wyckoff's plan. This is step number 2. The capital must be strategically allocated into a 2-component portfolio. Richard Wyckoff was not a reckless day trader, nor was he a passive buy-and-hold investor. He was a complete financial operator, and he understood that a sound financial structure requires both a defensive and an offensive wing. His approach, as detailed in his own writings, was to divide his capital into 2 distinct and separate funds, each with a different purpose. The first and larger portion of the portfolio would be allocated to what he termed the investment fund. The primary objective of this fund is the preservation of capital and the generation of a steady, reliable income. In his day, Wyckoff favored exceptionally safe, high-quality bonds, such as the equipment trust bonds issued by major railroads. The modern equivalent of this would be a portfolio of high-grade government or corporate bonds or other conservative income-producing assets. This portion of the portfolio acts as the great stable anchor. It is the financial bedrock that provides security and peace of mind, allowing the operator to conduct his more speculative activities from a position of strength, not desperation. The precise allocation would depend on the operator's personal circumstances, but a conservative starting point in the Wyckoffian tradition might be to place 60 to 70% of the total capital, $60,000 to $70,000, into this defensive income-generating fund. The remaining 30 to 40% of the capital, $30,000 to $40,000, would be allocated to the second component, the speculative fund. This is the working capital in the truest sense. It is the fund that will be used to actively and aggressively conduct the trading campaigns that are the subject of our studies. It is the offensive wing of the operation, the fund from which great profits are to be sought. However, it is a fund that is perpetually protected by the larger, more conservative investment fund. This two-component structure is a masterpiece of financial engineering. It provides a framework that is both secure enough to withstand market storms and dynamic enough to capitalize on major opportunities. It is the structure of a professional business, not of a gambler's fleeting stake. This video will give you the foundational rules of the Wyckoff method. But to apply these rules with the conviction of a professional, you need to understand the judgment that forged them. That judgment is the very heart of Richard Wyckoff's masterwork. How I Trade and Invest in Stocks and Bonds. This book is not a dry technical manual. It is the record of a 33-year career on Wall Street. Inside, Wyckoff shares his own campaigns, detailing the logic behind his profitable trades in stocks like U.S. Steel and his long-term speculative investment in Magma Copper. He dissects the methods of other market titans, analyzing the principles of legendary operators like Jesse Livermore and his double-stop rule, the industrialist E.H. Harriman, and the aggressive pool operator James R. Keene. The best way to access this timeless wisdom is through the modern, adapted edition by Max Davidson. Its annotations act as your personal guide, translating the historical context for today's markets, and it includes illustrations and photos of the very traders Wyckoff used as examples. If our videos teach you the what, this book teaches you the how and the why. It is a complete course in building a professional mind. The link is in the description. With the capital allocated and the portfolio structure defined, we arrive at the third and final step of the initial strategic phase. This is step number 3. A thorough and dispassionate analysis of the general market must be conducted. Before a single dollar from the $30,000 speculative fund can be deployed, the operator must first determine the current trend and position of the market as a whole. Wyckoff's first and most important golden rule was to always trade in harmony with the great market tide. To launch a speculative campaign for the long side while the market itself is in a weak or declining state is a low-probability endeavor that the professional systematically avoids. Wyckoff's daily work began with a meticulous study of the major market averages. In today's market, this would translate to a rigorous analysis of the benchmark indices, such as the S&P 500 and the NASDAQ composite. He would not be concerned with the day-to-day news or the opinions of economists. His analysis would be focused solely on the chart, on the market's own, unambiguous action. He would study the price and volume signatures of these indices to determine which of the 4 market phases is currently in control. Is the market currently in a state of accumulation, forming a great base after a prior decline? If so, Wyckoff would stand aside, patiently monitoring the developing cause and awaiting the first signs of a new uptrend before committing his capital. Is the market in an active markdown? A confirmed downtrend? If so, the speculative fund would remain 100% in cash. To attempt to buy stocks in such an environment would be a violation of his most fundamental principles. Is the market in a state of distribution, a topping process where the evidence suggests that the composite operator is selling? Again, the speculative fund would be held in cash. To buy into a market that is being secretly and methodically sold by the smartest money is a fatal error. The only environment in which Wyckoff would begin to actively deploy the capital from his speculative fund on the long side is when his analysis of the general market averages confirms that the market is in a healthy, sustained markup phase, a confirmed uptrend. It is only when this most powerful of all market forces is acting as a tailwind that the professional operator will unfurl his sails and begin to seek out individual campaigns. This final step of the strategic briefing is the great traffic light for the entire speculative operation. It tells the operator when to proceed with caution, when to stop entirely, and when, and only when, the conditions are favorable to press forward with his offensive campaigns. Having established the foundational principles for our $100,000 portfolio, a professional attitude toward capital, a sound two-component structure, and a firm understanding of the general market's trend, we now proceed from the high-level strategic phase to the practical, tactical work of stock selection. The following 4 steps constitute the rigorous filtering process that Richard Wyckoff would have applied to identify specific, high-probability opportunities for his $30,000 to $40,000 speculative fund. This is the process of transforming a broad market assessment into a focused, actionable plan. Step number 4. The identification of the leading industry sectors. Wyckoff understood that the market does not move as a single uniform entity. It is a market of stocks, and these stocks are grouped into distinct industries. At any given point in a major market cycle, certain industries will be in a far stronger technical and fundamental position than others. The great informed interests, the composite operator, do not scatter their immense capital randomly across the entire market. They concentrate their buying power in those specific sectors that they believe offer the greatest potential for leadership in the coming advance. Our first tactical objective, therefore, is to identify the footprints of this concentrated buying. The process for achieving this is a direct and logical application of the principle of relative strength. With our analysis of the general market averages confirming that the primary trend is upward, we now engage in a systematic, comparative analysis of the major industry sector indices. In today's market, this would involve comparing the charts of sectors such as technology, industrials, healthcare, energy, and financials against the benchmark S&P 500 index. The objective is to find those few sectors that are demonstrating clear and persistent outperformance. A leading sector is one whose price chart shows that it is rising faster and further than the general market during advances, and that it is falling less or holding its ground more firmly during market corrections. This superior price action is the market's own, unambiguous declaration of professional sponsorship. It is the evidence that the composite operator is actively accumulating positions within this group. Any sector that is lagging the market, that is failing to keep pace with the averages, is by definition being neglected or actively distributed by the smart money. Wyckoff would have ruthlessly discarded these lagging groups from any further consideration. His speculative fund would only be deployed in those areas where the evidence of professional interest was strongest. Step number 5. The selection of the leading individual stocks within those leading sectors. Once the handful of strongest industry groups has been identified, the filtering process becomes even more refined. The next step is to drill down into these leading groups to identify the 1, 2, or perhaps 3 individual stocks that are the undisputed leaders of the pack. A professional campaign is always conducted using the best available instruments, and in the stock market this means the strongest of the strong. The methodology for this is identical to the one used for selecting the leading sectors. It is, once again, a direct application of the principle of relative strength, but on a more granular level. The analyst takes the charts of the primary component stocks within a leading industry and compares their individual price action to the action of the sector index itself. A true leader is a stock that is outperforming its own group. It is the first to make a new high as the group emerges from a base, the one that rallies most forcefully, and the one that shows the greatest resilience during minor pullbacks. This exceptional performance is the final and most specific footprint of the composite operator. It signals that this particular company has been chosen as a primary vehicle for a major professional campaign. It is here that the most aggressive and intelligent accumulation is taking place. At the conclusion of this step, Wyckoff's initial broad analysis of the entire market would have been narrowed down to a short, highly potent watch list of perhaps 5 to 10 individual stocks. These are the A-class candidates, the only securities deemed worthy of the close day-to-day monitoring that is required in the next phase of the plan. Wyckoff's genius was his ability to decode the market by studying the chart. But his deep judgment was also formed by observing the great operators of his time, understanding their triumphs, their failures, and their mindset. To truly master the markets, one must study the masters themselves. This is why we have created a new channel, Wall Street Memoirs. This channel is a library of market history and wisdom, dedicated to the most important events, thoughts, memories, and strategies of the world's most famous investors. You will find valuable information that will help you both preserve and compound your capital by learning directly from the titans of finance. If you want to understand the minds behind the greatest market campaigns and learn from their hard-won experience, we invite you to subscribe and explore. The link is in the description. Step number 6. The verification of a sufficient cause. Before any of the stocks on our newly created watch list can be considered for an actual commitment of capital, they must pass a final, critical test of potential. A professional speculator, as a manager of a $100,000 portfolio, does not risk his capital for small or insignificant gains. He seeks opportunities that offer the potential for substantial, campaign-worthy profits. This is the practical application of Wyckoff's great law of cause and effect. This law, as we have studied, dictates that a significant market move, the effect, must be preceded by a commensurate period of preparation, the cause. For a long-side campaign, this cause is the base of accumulation that is built by the composite operator. Having selected a leading stock, Wyckoff would now subject its chart to a thorough examination to ensure that the cause it has built is substantial enough to warrant a campaign. He would be looking for a broad, well-structured, and prolonged period of accumulation. A stock that has only traded sideways for a few weeks has not built a sufficient cause to fuel a major advance. Such a stock would be rejected, as the potential reward would be too limited to justify the risk. He would be searching for those leaders that have undergone a long and patient preparatory campaign, often lasting for many months. The longer and more extensive the work done by the composite operator in absorbing the supply during this phase, the greater the potential for the subsequent markup. To add a quantitative dimension to this analysis, Wyckoff would have employed the point and figure chart. By performing a horizontal count of the columns within the point and figure accumulation pattern, he could derive a logical evidence-based price objective. This projection would tell him, in concrete numerical terms, the approximate profit potential of the campaign. This is not a guess. It is a mathematical estimation based on the measured energy stored within the cause. Only those stocks whose point and figure count indicated a substantial upside potential, a potential reward that was a large multiple of the initial calculated risk, would be retained for the final step. Step number 7. The final checklist of technical evidence. A stock may be a leader in a strong group and may have built a sufficient cause, but it is not yet ready for purchase. The final step in the selection process is a patient, day-to-day monitoring of the stock's price and volume action, awaiting the final, conclusive pieces of evidence that prove that the accumulation is complete and that the stock is on the very springboard of a new advance. A campaign is not launched based on potential alone. It is launched based on a final, definitive, and timely confirmation. This requires the analyst to wait for the successful completion of the entire sequence of Wyckoffian accumulation events. He must have already identified the initial stopping action of the prior downtrend and have witnessed the long process of absorption within the trading range. Now, in this final stage of his analysis, he is waiting for the two most critical events. First, he must wait for the final test of supply, which is the spring or shakeout. This is the final bearish trap, the deliberate thrust below support that proves that the selling pressure is exhausted. The successful completion of this test is an almost non-negotiable prerequisite for a high-quality A-class setup. Second, having witnessed the successful test, he must then wait for the first definitive proof of bullish intent. This is the sign of strength, the powerful breakout from the trading range on a wide spread and high volume. This is the market's own declaration that the period of preparation is over, and the markup phase is beginning. A stock remains on the watch list, in a state of monitoring, until this full and complete body of evidence has been presented. To act before the shakeout and the subsequent sign of strength is to act prematurely, on an incomplete set of facts. This final rule of selection is a rule of patience, the discipline to wait for the market to give the final, unequivocal green light before a single dollar of the speculative fund is ever committed. The strategic and tactical phases of our hypothetical campaign are now complete. A rigorous top-down analysis has confirmed that the general market environment is favorable, and a meticulous filtering process has isolated a leading stock that has just demonstrated its readiness to move with a clear sign of strength. We now transition from the realm of selection to the realm of action. The following 3 steps detail the precise professional execution and the subsequent management of the speculative campaign, showing exactly how Richard Wyckoff would have transformed his dispassionate analysis into a real managed position within the $100,000 portfolio. Step number 8. The low-risk entry and the calculation of the position. The discipline of a professional speculator is most acutely tested at the moment of commitment. The amateur, driven by the fear of being left behind, will invariably chase the excitement of the initial breakout. Wyckoff would have viewed this as a cardinal sin. His 8th rule would be to enter the position only at a point where the risk is at its absolute logical minimum. This requires the supreme patience to wait for the market to present a final, confirmatory opportunity. This opportunity is the last point of support. After the powerful initial advance of the sign of strength, it is a natural and common occurrence for the price to experience a minor secondary reaction. This pullback serves to test the area of the breakout, the former line of resistance, to see if it will now serve as a new floor of support. This test is the professional's entry signal. Wyckoff would have waited with unwavering discipline for this event to unfold. His entry would not be a panicked click at the market, but a calm, premeditated order placed at this logical point of support. The final confirmation to act would be the character of the pullback itself. It must occur on distinctly light and diminishing volume, which is the market's own final declaration that the selling pressure has been exhausted. Having identified this precise low-risk entry point, the next step is the mathematical calculation of the position size. This is where the foundational rule of capital preservation is put into practice. Wyckoff, operating with his $100,000 portfolio, would have strictly adhered to his 1 to 2% risk rule. Let us assume a conservative 1% risk for this campaign. This means the maximum acceptable loss for this entire operation is $1,000. The position size is then calculated in a simple 3-step process. First, determine the entry price, the price at the last point of support. Let us say this is $50 per share. Second, determine the logical stop-loss point, the price that invalidates the thesis. This would be just below the low of the last point of support. Let us say this price is $48 per share. Third, calculate the per-share risk. This is the difference between the entry price and the stop-loss price. $50 minus $48 equals $2 per share. The final calculation is to divide the maximum acceptable dollar risk for the trade, $1,000, by the per-share risk, $2. 1,000 divided by 2 equals 500. Therefore, the correct position size for this campaign is exactly 500 shares. The total value of the position would be $25,000, 500 shares at $50 per share, which would be well within the $30,000 to $40,000 limit of our speculative fund. This mathematical risk-first approach is non-negotiable. It ensures that the campaign is sized according to the principles of capital preservation, not according to a hopeful guess about its potential profit. Step number 9, the management of the campaign. Initiating a position is only the beginning of the operator's work. A campaign, once launched, must be managed with professional skill and detachment in order to see it through to its logical conclusion. This requires a systematic process for protecting profits and for making decisions based on the market's action, not on emotion. Wyckoff's primary tool for this would have been the trailing stop. After the position is initiated and the stock begins its markup phase, the initial protective stop loss at $48 remains in place. However, after the stock has made a significant advance and has then completed its first natural secondary correction, the stop loss order is moved up. The new stop is placed at a logical point just below the low of that completed correction. This process is repeated as the trend unfolds, with each new leg of the advance to a new high, followed by another logical correction on low volume. The trailing stop is methodically moved higher. This mechanical technique is a powerful antidote to the emotional errors that plague the amateur. It prevents the fearful impulse to snatch a small profit on a minor dip, and it forces the operator to remain in the position and to allow the trend to run. During the course of the campaign, Wyckoff would have also considered the possibility of pyramiding, which is the practice of adding to a winning position. This is a technique for the advanced operator only, and it must be done according to strict rules. Wyckoff would have considered adding to his initial 500 share position only at a subsequent secondary last point of support. This would be a new, smaller reaccumulation pattern that forms after the initial advance. He would have entered a new, smaller position at this point, with a stop loss placed just below the new support area, and he would have recalculated his total risk on the entire, now larger, position to ensure that it still remained within his acceptable parameters. Pyramiding is a method of pressing an advantage, but only from a position of strength, and only when the market's own action provides a new, low-risk opportunity to do so. Step number 10. The conclusion of the campaign and the rebalancing of the portfolio. Every campaign must have an end. A professional operator does not fall in love with a stock. He is in a business relationship with it, and that relationship concludes when the evidence indicates that the great upward move is over. The final phase of the campaign is the exit. The decision to exit is not an emotional one, it is an evidence-based one. As the stock approaches the price objective that was calculated from its point and figure chart back in Step 6, Wyckoff would have begun to watch the price and volume action with heightened vigilance. He would now be searching for the first telltale signs of a new campaign of distribution. He would be watching for a potential buying climax, a day of climactic volume where the price fails to hold its high. He would be scrutinizing the character of the rallies, looking for a divergence between effort and result, where a great deal of volume is no longer producing any significant upward progress. The appearance of these clear, technical signs of distribution would be his signal that the composite operator has now turned from a buyer into a seller. This is the signal to conclude the campaign. The exit itself would be conducted with professional calm. Wyckoff would not wait for the final, catastrophic break to the downside. He would use the public's remaining optimism and the rallies within the new distribution top as his opportunity to sell his 500 shares, realizing his profit. With the campaign concluded and the profit now secured in cash within the speculative fund, a final strategic decision must be made. Wyckoff would first reevaluate the general market. Is the market as a whole still in a strong uptrend? If so, and if another A-class candidate that meets all his exacting criteria is available, he may choose to immediately redeploy this capital into a new speculative campaign. However, a more conservative and businesslike approach, especially after a substantial gain, would be to rebalance the portfolio. He might decide to take a portion of the profits and perhaps the original capital from the speculative fund and move it over to the conservative investment fund. This action locks in the gains, reduces the overall risk of the portfolio, and compounds the stable income-producing base of the entire enterprise. This is the final act of a professional operator, turning a successful speculation into a permanent increase in his foundational wealth. In our final conclusion, we have laid out a complete 10-step blueprint for how Richard D. Wyckoff would have approached the task of building a $100,000 portfolio from scratch in today's market. We have seen that his approach is not a hunt for quick, speculative profits, but the methodical and patient construction of a sound, professionally managed financial enterprise. The process begins with a foundation of capital preservation and a balanced portfolio structure. It proceeds through a rigorous top-down filtering process to identify only the highest probability opportunities. It demands a patient, low-risk entry, and it is managed with unemotional, mechanical discipline. And it concludes with a logical, evidence-based exit and a strategic reallocation of profits. This is not a system for gamblers. It is a complete end-to-end business plan, grounded in logic, patience, and a profound respect for the management of risk.